Welcome to the Property Wealth Podcast. I'm really excited to dive into today's episode. You know, flipping houses is such a hot topic right now, and if you're thinking about it, you've probably heard of hard money and private financing.
Absolutely, Sarah. It's one of those crucial decisions that can really make or break a flip project.
Right? And it can feel a bit overwhelming, especially if you're new to it. But that's why we're here, to break it all down.
Exactly. We'll be discussing the differences between hard money loans and private money loans, how to choose the right one for your project, and the pros and cons of each financing option.
And we'll also share some real-life examples. You know, stories that illustrate how these financing options play out in the real world.
Yeah, real experiences are so valuable. They can really help listeners see what's possible or what to avoid.
Plus, we'll touch on some tips for negotiating better terms and finding the right lenders, which is super important for anyone looking to invest.
For sure. It's all about making informed decisions so you can build that wealth over time, you know?
Exactly. So whether you're just starting out or looking to refine your strategy, we've got some practical advice coming your way. Let's jump right into it.
Sounds good. Let's start with hard money loans and what they actually are. You know, Sarah, when we talk about financing options like hard money and private money, it really resonates with folks over 40, especially when you consider where they are in their lives. They might be thinking about retirement soon, right?
Absolutely. And I think a lot of people in that age group are starting to feel the pressure of like inflation and rising costs. It's not just about saving anymore. It's about making their money work harder for them.
Exactly. I mean, think about it. If you're looking at a fixed income in retirement, you want to ensure that your investments, like real estate, can keep up with inflation. That's where understanding these financing options becomes crucial.
Right. And I've seen so many investors, especially those in their 40s and 50s, who are now shifting their focus towards real estate because they see it as a hedge against inflation. They want tangible assets that can appreciate over time.
Yeah, and let's not forget the emotional side of this. For many, financial security through property isn't just a numbers game. It's about peace of mind. They want to feel secure in their retirement, knowing they have something solid behind them.
Exactly. I spoke to a woman named Linda the other day. She's in her early 50s, and she's been investing in rental properties for the last decade. She mentioned how much more comfortable she feels now, knowing her properties are generating income.
That's a great example. And in stories like Linda's that really highlight how important it is to have a solid strategy in place. The wealth transfer to family is another big factor. People want to leave something behind for their kids, right?
Yes, that's so important. I mean, it's not just about building wealth for themselves anymore. It's about creating a legacy. Real estate can be a fantastic way to do that, especially if they're able to leverage financing options effectively.
Absolutely. And when they're looking at financing options like hard money or private money, it's crucial for them to understand how each can serve their goals. Hard money can be a quick solution for flipping properties, but private money might offer more flexibility, especially if they're looking for long-term holds.
Right. And I think a lot of people over 40 might feel hesitant about hard money loans because of the perceived risks. But if they really understand how to use it properly, it can lead to some really profitable deals.
Exactly. I mean, let's say you have an investor named Tom. He's 48 and he found a distressed property that he wanted to flip. He didn't have enough cash on hand, but he also didn't want to wait for bank approval, so he turned to hard money.
That's a smart move. Did he have a good experience with it?
He did. He was able to secure the funds quickly, renovate the property, and flip it within a few months. The profit he made helped him pay back the loan and then some. It gave him that financial cushion he was looking for.
That's impressive. It's all about being strategic, isn't it? And for someone in Tom's situation, that quick access to cash can really make a difference in how they approach opportunities.
Yeah, and on the flip side, no pun intended, let's talk about private money. I know a couple who used private financing to purchase a rental property. They had a family friend who was willing to lend them money at a lower interest rate than a hard money lender.
That's such a relatable scenario. Using private money can really help to keep costs down, especially over the long term. How did that turn out for them?
Well, they ended up with a great property in a desirable area. The friend was happy to help, and they agreed on a repayment plan that worked for everyone. Plus, the couple was able to turn that property into a cash-flowing asset for retirement.
That's a fantastic outcome. It really shows how important it is to build relationships and networks, especially as you get older. Finding those private lenders can be easier when you have established connections.
Exactly. And that's the beauty of investing over 40. You've likely built a network over the years that can support your financial goals. Whether it's through family, friends, or professional contacts, those relationships can really enhance your investing strategy.
And just to circle back a bit, I think it's important for listeners to understand that this isn't just about making money. It's about building a life that feels secure and fulfilling. So much of our happiness in later years comes from financial stability, doesn't it?
It really does. And that emotional aspect can't be overstated. Many people are looking to create not just wealth, but also freedom to spend time with family. Enjoy life without financial stress. It's part of that long-term vision.
Okay, so as we wrap up this section, I think it's clear that understanding flip financing options like hard money and private money can really empower listeners over 40. It's about making informed choices that align with their goals and values.
Absolutely. And with that understanding, they can confidently transition into the core strategies that will help them leverage these options effectively. So when we're diving into flip financing, the two big players are hard money and private money. Each has its own pros and cons.
Right, and it's so important to understand the differences. I mean, hard money lenders are typically more institutional, right? They look at the property's value rather than your credit score.
Exactly. They're focused on the potential of the asset itself. So if you find a property that's worth, let's say, $200,000 after repairs, but you can snag it for $120,000, a hard money lender will see that value and might finance you for, say, 70% of the after repair value, which in this case would be about $140,000.
That's a solid loan-to-value ratio. And then you've got the money to buy and do the renovations, right?
Yep, plus they usually charge higher interest rates, so you want to be mindful of that. It's not uncommon to see rates ranging from 8% to 12%. And you might also have to pay points up front.
Points? Like fees? Based on the loan amount?
Exactly. 1 point is 1% of the loan amount. So if you're borrowing $140,000 and there's a 2-point fee, that's $2, $800 right off the bat.
Got it. So if I'm doing the math, that adds to your upfront costs.
Right, and that's where the numbers start to get critical. You need to factor in all your costs to ensure you're still making a profit.
And this is where the 1% rule comes in, right?
Yes, the 1% rule suggests that the monthly rent should be at least 1% of the purchase price. So if you buy a property for $120,000, you want to be aiming for around $200 in rent per month to break even.
That's a quick way to gauge whether a property is worth it, isn't it?
Absolutely, and it's a good first filter. But for flips, you also want to keep an eye on the 50% rule.
The 50% rule? What's that one about?
It's basically a guideline for estimating your expenses. When you're looking at your potential rental income, assume that about 50% will go to operating expenses, maintenance, property management, taxes, that kind of thing.
So if you're expecting to get $2,000 a month in rent, you should plan for about $1,000 in expenses?
Exactly. And that gives you a clearer picture of your potential cash flow.
That's super helpful. So what about the private money side of things?
Private money can be a little different. It often comes from individuals, friends, family, or investors who are willing to lend you money based on trust rather than strict financial criteria.
So it's more personal?
Yeah, it can be. And sometimes they might offer better terms, like lower interest rates or more flexible repayment plans. But it can also get tricky if expectations aren't clear.
I can see how that could lead to awkward situations.
Right? You want to make sure you're both on the same page about repayment timelines and potential risks.
Speaking of risks, what kind of deal evaluation checklist should someone use when considering a flip?
Great question. First off, you want to evaluate the purchase price. Make sure it's below market value. Then assess your estimated repair costs.
And you'd want to get multiple bids from contractors for that, right?
Yes, getting different estimates helps you avoid being blindsided by costs. Next, look at the after repair value, what you can realistically sell the property for after renovations.
And don't forget about the holding costs.
Exactly. You want to factor in things like property taxes, insurance, and utilities while you're waiting to sell.
How long should you estimate for holding costs?
Typically, I'd say around 6 months is a safe bet, but it really depends on the market.
So, if you're looking at a property where you think you could sell for $300,000 after putting in $50,000 in repairs, you need to ensure your total costs, including purchase price, repair, and holding, are significantly less than that sale price.
Right. You want to aim for a profit margin that makes it worth your time and effort. A common rule of thumb is to aim for a 20% return on investment.
So, in that scenario, if you're hoping to sell for $300,000, you'd want to keep your total costs under $240,000, right?
Exactly. And that's where running the numbers meticulously comes into play.
Now, what about the types of properties? Are there certain ones that are better suited for flipping?
Generally, single-family homes are the most common flips. They appeal to a wide range of buyers. But you can also find opportunities in multifamily units, depending on the market.
And location is key too, I assume?
Absolutely. Look for areas with good schools, job growth, and amenities. Those factors can significantly increase your property's value.
It sounds like there's a lot to consider.
Definitely. And it's easy to get overwhelmed. But if you stick to your checklist and keep an eye on your numbers, you can really set yourself up for success.
And as we dive deeper into this topic, what are some common pitfalls you see investors fall into?
You know, Sarah, when it comes to flipping houses, one of the biggest mistakes I see investors make is over-leveraging. They get so excited about a potential property that they stretch their finances too thin.
Right, and that can really backfire, can it? Like, if you take on too much debt and then the market shifts or unexpected costs pop up.
Exactly. I had a client once. Let's call him Tom. He found a great deal on a fixer-upper and decided to finance it heavily, thinking he could flip it quickly. But what he didn't account for were the hidden costs.
Like renovations that go over budget?
Yes, and also the carrying costs, property taxes, insurance, utilities. All of that adds up while you're waiting for the project to be completed. Tom ended up in this cash flow crunch because he didn't factor those in.
Oof, that's tough. So what happened to Tom?
Well, he ended up having to sell the property for less than he expected, just to get out from underneath the debt. It was a hard lesson for him, but it really highlights the importance of being realistic about your finances and knowing your limits.
Absolutely, and it's not just about the purchase price, right? I mean, bad tenants can be another pitfall.
For sure. I've seen investors take on properties that looked great on paper, but then they didn't screen their tenants properly. One investor I know, let's call her Lisa, had a nightmare experience with a tenant who was always late on rent.
Ugh, that's a classic issue.
Yeah, and it got worse. Lisa was so focused on the potential cash flow that she ignored the red flags during the application process. The tenant had a history of evictions, but she thought, oh, it'll be fine.
You know, it's so easy to want to see the best in people, but that can really cost you in the end.
Exactly. And when the tenant stopped paying rent, Lisa found herself in a lengthy eviction process, which only added to her costs. It's a real reminder to do your due diligence, for sure.
So what's the lesson there? Always check tenant histories?
Definitely. And also, consider working with a property management company if you're not comfortable handling tenant relations yourself. They can help mitigate those risks.
That makes sense. And what about cash flow? I think a lot of investors get caught up in the excitement of a potential flip and forget to keep an eye on the cash flow.
Yes, keeping an eye on cash flow is crucial. I had another client, let's say his name is Jack. Jack bought a property, excited about the renovations and the potential profit, but he didn't pay attention to how much he was spending monthly while the property sat vacant.
Oh no.
Right? He thought he could just do a few quick updates and sell it right away, but the market turned, and he ended up holding onto it for far longer than he anticipated. His carrying costs skyrocketed while he was waiting for the market to improve.
That's such a tough spot to be in. So, it's important to have a financial cushion, I guess?
Exactly. Always plan for the unexpected. And speaking of unexpected, timing the market is another common pitfall.
Yeah, I've heard that can be tricky.
It really can. I remember a fellow investor, let's call her Emma. She was convinced that the market would peak right before summer, so she rushed into a purchase, thinking she'd flip it in time for the busy season. But guess what happened?
Let me guess. The market dipped?
Bingo! Prices fell just after she bought. She ended up having to hold the property longer than she planned, and her profits shrank significantly.
Wow, that must have been frustrating.
It was. The lesson here is, while you can try to time the market, it's often unpredictable. It's better to focus on the fundamentals of the property itself, rather than trying to chase trends.
So true. And then there are those hidden costs.
Yes, they can really sneak up on you. I had an investor friend, let's call him David, who bought a property thinking it needed just cosmetic updates. But once he got into it, he discovered major plumbing issues.
That's always a headache.
Right? His renovation budget ballooned, and he hadn't accounted for those hidden costs in his financing strategy. It was a tough pill to swallow because he had to dig into his savings to cover the repairs.
That's a reminder to always get a thorough inspection, right?
Absolutely. A good home inspection can reveal a lot, but even then, you should have a buffer in your budget for those unexpected repairs.
And it's key to have a solid exit strategy too, right?
Exactly. Knowing how you plan to sell the property before you buy it can save you a lot of headaches later on.
So what can investors do to spot these red flags early?
Well, it starts with education. Understanding the market, knowing your numbers, and not rushing into a purchase just because it seems like a good deal.
Right. And I guess networking with other investors can help too. Learning from their mistakes and experiences.
Absolutely. Surrounding yourself with others who have been there can provide invaluable insights. And don't be afraid to ask questions, even if it feels a bit daunting.
That's solid advice, Mike. So if someone finds themselves in a tough spot due to any of these pitfalls, what's the best way to recover?
Well, first, take a step back and assess the situation. Look at your finances, see where you can cut costs, and maybe even consider a cash flow analysis. Sometimes, it's about adjusting your strategy rather than throwing in the towel.
That's encouraging. It sounds like there's always a way to pivot.
Exactly. Real estate investing is a journey, and the key is to learn from each experience, good or bad.
And that's what we're here for, right? To help our listeners navigate those tricky waters.
Absolutely. So let's get into some next steps for our listeners.
Sounds great.
So now that we've explored hard money and private financing, let's talk about some immediate steps you can take. Yeah?
Absolutely. It can feel overwhelming, but the key is to start small and keep it simple.
Right. One of the first things I recommend is to analyze one deal per week. Just pick a property you're interested in, run the numbers, and see how they stack up. It's all about getting comfortable with the process.
That's a great idea. And there are some fantastic tools out there that can help you with that. Have you heard of the BiggerPockets calculator?
Oh yeah, the BiggerPockets calculator is a gem. You can input different variables like purchase price, rehab costs, and financing terms to see what your potential returns could be.
And it's user-friendly too, which is a bonus for those just starting out. Another tool I love is DealCheck. It allows you to analyze properties in detail and compare them side by side.
Exactly. You can even track your properties over time, which is handy if you're looking at multiple options.
And let's not forget about Zillow. It's not just for looking at homes to buy. You can also check out rental prices in your area, which gives you a feel for the market.
That's so true. Knowing your local market is crucial. I'd also suggest checking out Rentometer for rental rate analysis. It gives you a good idea of what similar properties are renting for, right?
Yes! And if you have access to your local MLS, that's an incredible resource. You can find sold properties, see trends, and get a real understanding of what's happening in your area.
And speaking of resources, there are some great books out there. The book on rental property investing by Brandon Turner is a must-read. It covers so much ground and is super accessible.
I love that one. Another good one is Real Estate Investing for Dummies. It breaks things down really well, especially if you're feeling a bit intimidated.
Definitely. And podcasts can also be a great way to learn on the go. I mean, aside from this one, there are others like BiggerPockets Podcast that dive deep into real-life investor stories and strategies.
Yeah, those stories are really motivating. Hearing how others have navigated challenges can be so encouraging.
Right, and speaking of encouragement, I think it's essential to join a local meetup group.
Yes! Networking is key. Meeting other investors and sharing experiences can provide invaluable insights.
And it doesn't have to be a big commitment. Just attending one meeting a month can help you build connections and learn from others.
Exactly. Plus, you can share your own experiences and get feedback, which is super helpful.
And let's not forget about setting up some habits. Maybe dedicate a little time each week to read, analyze deals, or even just stay updated on the market.
Oh, totally. Just 30 minutes a week can make a difference. It's all about consistency, right?
Yes! And remember, it's okay to start where you are. Everyone's journey is different, and every small step counts.
So true. And if you feel like you need more guidance, consider finding a mentor. Someone who's been in the game can offer personalized advice and support.
Great point. Mentorship can be a game changer. And with these tools and strategies in your toolkit, you'll be well on your way to making informed decisions.
Exactly. So those are some practical first steps. Now let's bring this all together.
Well, Sarah, as we wrap up this episode, let's recap some of those key takeaways.
Absolutely, Mike. So first up, we talked about hard money loans, right? They can be a quick option for financing flips, but they come with higher interest rates and short repayment terms.
Exactly. And then we contrasted that with private money lending, which can offer more flexibility, like better terms and a more personalized relationship.
Right, and that's super important. Relationships can make a huge difference in the real estate game.
Definitely. Plus, we touched on the importance of having a solid plan in place before diving into either option. It's all about being prepared, wouldn't you say?
For sure. And let's not forget the significance of understanding your exit strategy. It's crucial to know how you'll pay back those loans, whether it's through selling or refinancing.
Yeah, so many factors to consider. But ultimately, both options can be powerful tools for building your portfolio.
Exactly. And for those listeners tuning in, remember, real estate investing is a journey. It's all about taking those steps, even if they seem small at first.
Right. And every bit of knowledge you gain brings you closer to that financial freedom you're aiming for.
So, if you found value in today's discussion, please like, subscribe, and comment below with your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone over 40 who's looking to invest in property. You never know who might need that extra nudge.
Next time, we're diving into post-flip property management transition. It's such an important topic.
Yeah, you won't want to miss it.
Thanks for joining us today.
We appreciate you being here.
Until next time, keep building that wealth through real estate.
Take care, everyone.